This is the Asia Trade. I'm Paul Allen in Sydney, where the market has just opened. The top stories this hour. Asian stocks eye gains after a tech rally lifted Wall Street following weaker than expected data on US consumer confidence. Hong Kong and Sydney set for a shortened session for Christmas Eve. Honda and Nissan unveil a tentative agreement to set up a joint holding firm that aims to list shares in August of 2026. And President Biden's administration launches an investigation into Chinese chips, offering President-elect Donald Trump a choice about possible tariffs. All right, let's take a look at how US futures are tracking. It was a pretty good session to close out what's going to be, well, not close out, but it is going to be a shortened trading week for the US. We had stocks higher, very low volume, though, heading into the holiday sessions. Big tech leading the way there. Nvidia, Meta, Tesla, among those that performed well. Got S&P futures, though, just better by a couple of points at the moment. Oil prices kind of tracking sideways as well, a little bit weaker, mainly due to a strong US dollar. Very thin pre-holiday trading there for oil as well. We have had news that Belarus and Hungary are again receiving Russian oil through the Druzhba pipeline after an unspecified outage last week. Let's take a look at how we are doing here in Australia in the early going. It is a staggered open, naturally, so hard to get a read on things. We're a little bit weaker right now, but it was a very good day for Australian stocks on Monday, up 1.7% almost. All sectors were higher, but we're going to have an early finish today and in New Zealand and in Hong Kong and in the US and in another number of other markets as well. It's going to be a public holiday, of course, for Wednesday, Christmas Day, Thursday here locally as well, and I wouldn't be expecting too much action on Friday either. Nikkei futures right now also looking pretty quiet heading into this holiday shortened week. We've got the yen, though, pretty weak, 157 there. We've got hedge funds piling into the yen, betting on a 5% rise in that pair in the coming months, with hedge funds looking at that would put the yen in a range of 160 to 165. The yuan also very weak on a strong greenback. Let's get to one of our top stories. Honda and Nissan announcing a tentative agreement to set up a joint holding company. Honda will be taking the lead and nominating a majority of the directors.
Once the definitive agreement is concluded, the holding company will be incorporated and be listed on the prime market of the Tokyo Stock Exchange, subject to obtaining necessary approvals from relevant authorities in resolution at each company's general meeting of the shareholders. The visibility of the timing is August 2026.
In order to work together, we need to benefit from the huge synergies. Otherwise, it wouldn't be meaningful in the eyes of the stakeholders. So that is why we agreed to start the discussion. That is why we are making this announcement today.
But the former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, Carlos Ghosn, told Bloomberg the two firms don't complement each other and that the deal doesn't make sense.
There is no complementarity. The two companies are two Japanese companies. They are strong in the same fields. They are weak in the same fields. Both of them have very developed technologies. From an industrial point of view, there is duplication everywhere. So industrially, for me, it doesn't make sense.
For more, let's bring in our Asia transport reporter, Nicholas Takahashi in Tokyo. Nicholas, we heard from Carlos Ghosn there. Of course, he's been speaking about this deal and he is sceptical of it. But can you talk to us about the synergies available, the scale available as well? And I imagine there's a lot of duplication here also. Has there been any discussion of potential job losses?
Well, I think with any merger, safe assumption we can make is that where there's overlap and where there's duplication, as former Chairman Ghosn said, there's going to be a lot of cuts, and that's part of what makes a merger a benefit for both companies, but also sort of a painful experience. In Honda's case, the big question is, what does the company have to gain from Nissan? For Nissan, the benefits are much more self-evident. As some folks will know, last month when they announced earnings, poor sales in the US and China really hurt profit. They had to cut jobs, lower production capacity, and slash their annual profit outlook. For Honda, on the other hand, things aren't perfect, but they're looking more in line with the sort of issues most legacy car makers are seeing in major markets. So in that regard, what Honda has to gain is possibly scale, which is what it's been looking to gain in the US and China to better compete with these legacy makers and disruptive new EV brands. But as Gon said, well, maybe we should take what he says with a grain of salt. He's got a lot of feuds left over with Nissan. Maybe he knows better than anybody the sort of synergies that exist or don't exist between these two companies.
Well, we've got a few deadlines named as well. One of them is the August 2026 deadline for the listing of this newly merged entity, and also a deadline for January about whether or not Mitsubishi will join this tie-up. Can you tell us more about both those things?
Those are definitely big factors. If I can start with the second one, with Mitsubishi, they've got a strong hybrid game in North America and across Latin America and Africa as well. So while the Honda-Nissan pairing, or let's say the Honda takeover of Nissan, is the main item here, Mitsubishi adding to the mix would definitely give the pair, or I guess the potential trio, a nice competitive edge, should that happen. But it is looking likely. And to answer the first question, the timing, I think, is an interesting factor. In the next 6 months, we should see negotiations start to materialize between Honda and Nissan as to who's on the board of directors for the holding company and what shape that takes. And then, as you said, in August, we'll hopefully see that holding company list. So now we've got the long-awaited timeline that we've been waiting for. The rest is to see how they form this partnership in a way that makes sense for all parties involved.
All right, Asia Transport reporter Nicholas Takahashi there. Well, Elon Musk, who has been appointed by US President-elect Donald Trump to make the government more efficient, has called the Federal Reserve overstaffed. Bloomberg News editor John Haidi joins us now. John, what is Elon Musk saying exactly, and has the Fed responded to this accusation?
Well, we haven't heard any specific response from the Fed as of yet. This is another provocative remark by, in this case, one of Trump's close allies and the president-elect himself. But unlike, say, departments that are directly under the executive branch, the Federal Reserve is much more independent by tradition and by the choice of its leaders and of the White House. It does not. The salaries of its employees are not paid by Congress, but by the bank's operations, including interest on securities, on bonds that the bank issues, or has bought rather.
I wondered if you could tell us a little bit more about another story that's going around as well. President-elect Trump saying that the US should take possession of Greenland. Now, I first heard of this story when it hit my social media feeds yesterday. I assumed somebody was fishing for a laugh. They're not. What's this about?
Well, again, like with the Musk remark about the Fed, it's part of this provocation or saying outlandish things that has been the trademark of Donald Trump and people around him. Now, he first broached this possibility back in 2019 of buying Greenland, which is an autonomous part of Denmark, but the leader of Greenland and the Danish government has said flat out it's not for sale.
All right. Bloomberg News editor John Haidi, incoming President Trump continuing to make geopolitical waves. He hasn't even taken office yet. Well, President Biden's administration is launching an investigation into Chinese-made semiconductor chips. This is a move that could lead to new tariffs. China correspondent Min Min Lo joins us now from Hong Kong. Min Min, what's new about this investigation?
Yeah, this is an investigation that targets the legacy chips. So unlike the advanced chips that are very critical for AI development that the USA could help bolster Chinese military, these are chips that are very ubiquitous. They are used in everything from cars to mobile phones to medical devices. And these investigations, they typically take 6 to 12 months, according to experts. And so by the time it concludes, it would leave the decision of what to do with this outcome in the hands of President-elect Donald Trump and his incoming administration. It could pave the way for more tariffs or perhaps import restrictions. And the reasoning behind this is that U.S. officials say that if this technology, these legacy chips are overly controlled by the Chinese, they could pose a national security risk to the U.S. U.S. officials also say that Chinese policies now allow companies to set artificially low prices. And Gina Raimondo, the Secretary of Commerce, for example, said, look at what happened during the pandemic when the U.S. was trying to get hold of these chips, but they couldn't. And that shows the risk of over-relying on overseas suppliers. And this, by the way, adds on to the expanded restrictions earlier this year. The White House announced that it would be increasing tariffs on Chinese legacy chips from the existing 25% to 50% by next year.
So how about China's response? What's that been?
Well, obviously, China is opposed to this. The Chinese Commerce Ministry, in fact, pointed out that the U.S. is pouring in huge sums of money, subsidies, through the Chips and Science Act to support U.S. companies, which are now making up about half of global market share. And meanwhile, according to the Chinese Commerce Ministry, Chinese legacy chips make up only about 1.3% of U.S. market share. So the statement said that this is, quote, obviously self-contradictory, and that the U.S. is exaggerating the Chinese threat. China has vowed to take all necessary actions to protect its rights and interests.
All right, Bloomberg's China correspondent Min Min Lo there. We have more to come on the Asia trade. This is Bloomberg. All right, let's get to our next guest in just a moment. You're seeing a chart there of U.S. consumer confidence. We did get those numbers out a little bit earlier. We saw a drop in U.S. consumer confidence for, when was it? Well, it fell for the first time in 3 months. We're reading of 104. We're still in positive territory, but some of the write-in responses to that survey were interesting as well. People saying politics, tariffs highlighted as their main concerns. The majority see tariffs as increasing the cost of living. You see S&P futures modestly in positive territory. The next session in the US is going to be a shortened one due to Christmas Day. Joining us now, we have Jack McIntyre. He is portfolio manager at Brandywine Global. Jack, when you take a look at that drop in US consumer confidence, does it mean anything for you? And will it mean anything for a data-driven Fed?
So I think what's interesting, because the real weakness was in the expectation component. As you alluded to, there's a lot of uncertainty out there as well. So historically, if you start to see the expectation component underperform the present situation, maybe that starts to hint a little bit of a recession. But again, that's not today's story. Is it important for the Fed? Well, you know, the Fed last week, since they cut, but more importantly, kind of intimated that they are in a pause mode. And as part of being in a pause mode, they want to gather data, because they need to kind of figure out, you know, what is the next move they want to do. So every little bit of economic data is going to be important for the markets, and it's going to be important for the Fed.
Yeah, well, let's summarize the data as we know it and the likely trend. Look, we've got strong growth. Consumer confidence backed off a bit, but it's still looking pretty good. Jobs are strong. Inflation's hanging around. How hard is it to mount an argument here for more easing, particularly when we had one dissent at the last meeting saying, no, this is not the time?
Yeah. Yeah, I agree. I actually wonder, and we won't know, but maybe the minutes might give us a little color, is that if the markets hadn't already priced in a rate cut, would the Fed have actually cut rates? Because everything Powell said kind of suggested that, hey, maybe they didn't need to do that. And as you pointed out, we've got roughly about 3% growth. We've got 6% budget deficits. The Fed has eased policy rates by 100 basis points. We've got a wealth effect because equity prices are close to the all-time highs. So, yeah, that's why I'm a little worried about the stickiness of inflation. And we've been cutting back on the duration because of that.
Yeah, where do you see inflation heading in 2025? There's a lot of known unknowns and unknown unknowns that could impact the direction of travel here. What's your expectation?
So if you break it down, the two primary components, goods, I think we've probably run the course on deflation. Having said that, it's very interesting to see how the holiday season goes, the demand side of it, because we know, and you alluded to it, because of tariffs, we've seen a ramp up in inventories. But I think the big heavy lifting of lower goods prices is probably behind us. So that shifts to the services side of things. And here, it's a little mixed from that standpoint. I mean, wages right now have actually been coming down, and that can be a source of inflation. But everything points towards inflation being a little stickier and bringing back to the Fed. One thing which didn't get a lot of highlight in the FOMC, the data points, the dots, was the continued uptick in the terminal rate. So it moved to 3%. Remember, for years it was 2.5%. So it's basically telling you that the market's still a little, the Fed is still a little worried about the real outlook for inflation, that rates ultimately are going to have to be higher to really keep inflation better contained.
Well, we have been hearing from one Fed speaker this week, that is, of course, Mary Daly of San Francisco. She said she's still comfortable with the idea of 2 cuts next year, but does stress the importance of data dependency. But she also made some remarks about AI as it's going to pertain to productivity. Let's have a little listen.
It's really about machine learning. It's about, robotic processing, automation, just businesses doing things. We're seeing it everywhere. I don't think we'll see it in measured productivity right away, and you shouldn't expect to, but it's the impetus of change is there.
Yeah, well, that AI trade really one of the stories of 2024. How are you trading around this, considering some of those big names are getting pretty expensive? Do you trade it in other ways, like healthcare or energy? What are you looking at?
Well, yes, okay, so I'm kind of a global bond macro view. But it's going to be fascinating to see how ultimately it plays out, because I do agree in the sense that you will get a productivity kicker around that. And I agree from a market standpoint, because I think last year, and maybe continued this year, the markets are rewarding the producers of AI, but we are a year or two from where the markets start to reward the users of AI. And maybe, again, the time frame could be accelerated, but that's something which you're going to see, and then ultimately it kind of ties into the conversation we're having about inflation as well, because if it really takes hold, it kind of shifts us to that Goldilocks, that you can see an uptick in economic performance without it being inflationary, and that's good for all financial assets.
Just in terms of your global bond macro view, we saw a pretty decent sale of 2-year note futures, a solid result there. What is your outlook for yields in 2025?
So this is where I don't have a tremendous amount of uncertainty. Having said that, I do see that growth is a kicker going into it, and then we've got to see what the fiscal side, because the biggest risk out there, and I think it's a fat tail, is that and particularly in the U.S., is that they try to overutilize the fiscal lever, and the bond vigilantes step up and send a message. We've seen that, the last couple of years. We're seeing it right now in Brazil. So that is a risk right now. But having said that, I actually think my mindset is that focusing on the 10-year part of the Treasury curve, it's going to be range-bound. I think you're supposed to buy treasuries when it gets closer to 5%, and anything below 4%, you're supposed to be lightening up. That's just right now the mindset, and we're coming into the year underweight U.S. Treasury duration.
And in terms of the incoming administration in D.C., I mean, we've already got President-elect Donald Trump stirring up the likes of Panama, Canada, and now Denmark over the ownership of Greenland. Can you see there's a political risk to markets here with some of this interesting rhetoric?
Well, this is classic Donald Trump. I mean, he loves to weaponize uncertainty. I think, actions speak a lot louder than words. So we'll have to see how this all plays out right now. But no, I think one thing that about President-elect Trump is that he really understands why he got elected. We know the immigration story, but also on the inflation side of things. He knows that he got elected because the U.S. consumer is sort of ticked off on inflation. So everything he does in terms of policy needs to be looked at through the lens of how does it impact inflation. I think he's going to get it. So I don't see this big surge of fiscal activity helping economic growth in 2025. But again, it's going to be a floor and help the economy going into 2025 and then 2026.
How's your allocation globally looking? Is the US the only game in town, or are you looking at putting money to work elsewhere?
So, well, what's going on in the emerging economies, particularly in LATAM, when you're getting a big backup in yields, without right now inflation kind of confirming that move, is potentially creating some opportunities. We're nibbling at some of those markets where we tend to be value-oriented, contrarian. The nice thing about buying some of these very high-yielding bonds is that you can withstand a lot of volatility because it pushes more of that total return on the yield, the coupon. So, but again, it can be painful. What we need to see is that these governments actually take steps to control their fiscal situation.
All right, Jack McIntyre, Portfolio Manager at Brandywine Global. Thank you so much for joining us today. We have more ahead on the Age of Trade. This is Bloomberg. This is the Asia Trade. Other stories that we're following from around the world. French President Emmanuel Macron has picked Eric Lombard to be the country's finance minister. Lombard, an experienced finance professional, faces the task of repairing France's finances after the collapse of the previous administration over next year's budget. The country's been in political turmoil since June, when Macron dissolved parliament and called for elections. Former US President Bill Clinton has been hospitalized for observations after developing a fever. A spokesman says the 78-year-old remains in good spirits. The former president was active on this year's presidential campaign trail. Clinton underwent quadruple bypass surgery back in 2004. A US bipartisan committee report has found what it calls substantial evidence that former Representative Matt Gaetz paid several women, including a 17-year-old girl, for sex and used illegal drugs while in Congress. The committee report accuses Gaetz of violating House rules and standards of conduct, including prostitution, statutory rape, and obstruction of Congress. Gaetz has denied all wrongdoing and dismissed the allegations. Luigi Mangione has pleaded not guilty to murder charges over the shooting of Brian Thompson, the CEO of United Health's insurance unit. Mangione appeared handcuffed in a Manhattan court to be arraigned on multiple counts, including first and second-degree murder, criminal possession of a weapon, and having a forged driver's license. His lawyer has expressed concern with the way the parallel state and federal cases were playing out, saying Mangione's being treated like a human ping-pong ball. We have more ahead on the Asia Trade. This is Bloomberg. Right, let's take a quick look at how we are tracking in terms of currencies here. Take a look at the yen, still pretty weak, 157, just a shade above at the moment. We do have hedge funds piling into this pair, betting on a 5% rise in USD Japanese yen in the coming months, and that would put the yen in a range of 160 to 165. I imagine the Ministry of Finance in Japan might have something to say about that. We've got the euro, meanwhile, weakening, drifting ever more slowly towards potential parity with the US. We did hear earlier from Emmanuel Macron appointing Eric Lombard as the finance minister, as we mentioned a moment ago. Although getting support to get things through the French parliament's not going to be easy. France is a minority government and the opposition not really in a compromising mood right now. Well, South Korea's Constitutional Court says it will hold a preliminary hearing on President Yoon Suk-yeol's impeachment as planned on December the 27th. Yoo-kyung Lee joins us now from Seoul. So, Yoo-kyung, tell us what's the latest.
Sure. So there has been some unexpected difficulties as the Constitutional Court was going to proceed with the impeachment trial over the embattled leader Yoon, because Yoon has been refusing to receive the documents that were needed for the Constitutional Court to proceed with the hearing on the impeachment case. After failing to deliver the court documents to Yoon, Constitutional Court said yesterday it will proceed with the preliminary hearing as planned on December 27th. And now there's another investigation ongoing over Yoon over his brief imposition of martial law. And that investigation team has also been facing difficulties sending the summons request to Yoon. So even though they wanted to question Yoon on December 25th on Christmas Day, there were questions, there were uncertainties whether Yoon would show up for the questioning, because he's been also refusing to receive the summons request. So even though Yoon vowed he would fight until the end during the trial procedures on his impeachment case, it looks like there has been suspicions that he was using these tricks to delay the hearing. Now we know that Constitutional Court will go ahead with the planned preliminary hearing regardless of that, and consider that Yoon has effectively received the court document in order to start the process.
So what are the potential scenarios here? I mean, what are the chances of President Yoon remaining president? And even if he does, surely it's just a matter of time before he goes anyway. Is he not fatally wounded in a political sense?
So it's quite difficult to tell, because we still have several months for the Constitutional Court to deliver. And we are also waiting for the lawmakers to appoint 3 more Constitutional Court judges, because we only have 6 judges on the Constitutional Court, and we need at least 6 votes from the Constitutional Court for the impeachment to go ahead. They are trying to appoint 3 more judges, so that's another uncertainty remaining. And once we start the preliminary hearing, we'll hear more from the Yoon side. And since Yoon's vowed to fight until the end to keep his position, there are still lingering uncertainties about what the result will be on this impeachment trial on Yoon.
All right, Bloomberg's Yoo-kyung Lee there. Well, South Korea is also urging tourists to continue visiting while actively engaging with foreign governments over the safety of travel groups. Now, that's as political tensions simmer following the now-impeached president's failed martial law attempt. We spoke exclusively with the Culture, Tourism and Sports Minister, In-Chon.
So we've been doing well, but this time something like this has happened in the middle of the administration. So in my case, I think that changes in the external environment will take time to be resolved. And internally, it's very important for us to communicate with each other, especially through culture. So in times like this, I think we should play a role in providing some comfort to people abroad. And I'm pushing ahead with my work with that in mind.
We have seen a long history of civil movements in South Korea, protests as well, and maybe a lot of drastic political measures, including several martial law declarations in this country. What do you think it takes when it comes to bringing stability to the government and to society as well? As a culture minister, when you see the trends in South Korean society, is this something that you think about?
I think it is very crucial that any expression can be voiced. That's another form of democracy, where people can come out in the square and talk to each other without being hindered, speaking out at ease. Once this time passes, there will be a time when they can communicate well among each other. Of course, at first there will be a gap, so they may clash, and the voices may become louder because of different opinions. But in the end, they will continue to clash and exchange views with one another, and through this process, they will get to bridge the gap and communicate. Of course, it can be a disadvantage on the one hand, but on the other hand, it is a very strong point that democracy is guaranteed and it's working properly.
Are you having conversations with other countries' government officials? Who are you hearing from?
At first, everyone was very surprised. Now, as time goes by, people seem to feel that social life is proceeding as usual. There are no major changes or cancellations at the moment. If you have plans to travel to Korea, go on a business trip or attend a conference, I would like to tell you that there is no problem if you come as planned.
From all of the government initiatives that you're working on, there have been reports that perhaps some of the regional festivals have been downsized, that a lot of the big works cannot be done anymore. What are you seeing so far?
Right now, there are festivals going on. It's the end of the year and there's also Christmas, so the atmosphere should be a little upbeat. But our political atmosphere is frozen right now, so local governments are staying low-key or scaling down the size of events. However, from my point of view, I'm telling organisers to proceed festivals as planned if possible, but it seems difficult to hold such festivals in full scale in this atmosphere. So the economy is a little bit strained at the moment, so I'm recommending that local governments should not cancel those events and festivals. They should hold such events so that they can provide some comfort to the people's hearts.
Do you expect that, though, to have a lasting impact on the broader economy if people are not going out to celebrate at this very holiday peak season?
I think domestic demand is being affected a little bit, as well as the stock market. But what's really important is the external credibility of Korea, not only in terms of the country's economy, but also in all other areas, such as trust and credibility. If this continues, we may find ourselves in a more difficult situation with investment outflows or declines.
That is In-Chon, the South Korean Culture, Tourism and Sports Minister, speaking with Shery. Right, we've got an update for you on the US Steel, Nippon Steel CFIUS deal. We were expecting a decision from CFIUS imminently, and now we have one, and it's perhaps not what you were hoping for. CFIUS unable to reach consensus on the US Steel, Nippon Steel takeover. So we've got this the review board telling the White House, you can't reach agreement on the national security risks involved of Nippon Steel's proposed acquisition of US Steel. So this sets the stage now for President Biden to make a decision, and that decision is likely to be that he kills that deal. CFIUS said on Monday that allowing the Japanese industrial giant to purchase US steel could lead to a reduction in domestic steel output, and that would represent a national security risk. But it wasn't able to reach a consensus on that, but seems likely that President Biden will now kill that deal off. We have more ahead on the Asia trade. This is Bloomberg. Take a look at this chart. This is mainland Chinese investors snapping up a record amount of Hong Kong stocks over the Stock Connect. Part of the story here is a weakening yuan, which has made those Hong Kong stocks more appetizing. But traders in Shanghai and Shenzhen have bought close to $100 billion worth of Hong Kong stocks over that link in the year to December 20th. Favorite stocks include Alibaba, Bank of China, and China Mobile. Well, Hong Kong's financial secretary says the city is prepared to weather US President-elect Donald Trump's protectionist policies. Paul Chan told us exclusively that the business hub's economy is stabilizing.
there are challenges and opportunities. Yes, what you have put, but on the other hand, we have seen the business sector responding. Say, for example, redistributing their industry chain. So we position ourselves as the supply chain management center, and also providing consulting services for these companies when they want to reallocate their supply chain in the region and try to consolidate their positions and open up new markets.
How much, though, could this? You have to have contingency plans. What levers do you have to enact if he follows through on what he is going to say he's going to do? I'm talking about Donald Trump, of course. You've already said that the outlook for GDP growth, I think the previous forecast for full-year growth would be between 2.5% to 3.5%, but you're now saying at the lower end. How do you protect that lower end of the band of growth?
Well, interest rate is coming down, which is good for business, good for the asset sector. And at the same time, our efforts in attracting strategic enterprises and talents are bearing fruits. At the moment, at least 100 strategic enterprises are coming. In the next couple of years, investing over 40 billion to 50 billion Hong Kong dollar, creating 17,000 quality jobs. We have approved those talents under the various schemes, about 230,000, and about 160,000 have already arrived in Hong Kong. These are the drivers, the impetus to help us grow our economy. And these talents are in the sectors that we need. So it would be very important for us to embrace them and to work together to grow ourselves, not just in the financial services sector, but also in the technology and innovation.
One of the great strengths has been the consistency of the dollar peg, obviously. There has been chatter out of Washington that perhaps the new president-elect would like to see less independence from the U.S. Fed. Is there any scenario that you would be considerably worried because of the dollar peg and essentially de facto central bank is the Fed?
Well, the pegged exchange rate system works very well for Hong Kong. We have no intention at all to change that. We have experienced different challenges over the past few years, so we have plans in hand to respond to any circumstances.
Hong Kong Financial Secretary Paul Chan there, speaking exclusively with our Chief North Asia correspondent Stephen Engel. We've been trading here in Australia now for about 45 minutes. It's going to be a shortened trading day today, heading into Christmas Eve, and we're anticipating very low volumes as well. In fact, we're kind of drifting sideways at the moment. Not a lot of movement on the ASX at all. The materials and financial sector are two of the laggards there, and they are combined make up more than half of the index by total. We had a warning earlier from the IMF as well that Australia's balance of risks is tilted to the downside, might be a potential stall in disinflation as well. IMF advising the government to avoid excessive spending and support the current restrictive monetary stance to achieve disinflation. Well, there's a lot of consternation about how the RBA's been on hold for more than a year now, and in fact it's pretty much only government spending that's keeping the country out of recession at the moment. Got a Aussie dollar weakening against the greenback as well. Well, let's get the latest now from the corporate front. Xerox has agreed to buy a printer maker Lexmark in a deal valued at $1.5 billion. Xerox shares jumped in New York on the news. The deal includes debt and other liabilities that Xerox will take on from the current owners, a group of Asian investors. Xerox will cut its dividend in half to help finance the takeover, which is expected to close in the second half of next year. Telegram CEO Pavel Durov says the social media app is profitable for the first time after paying down about $2 billion in debt. Durov says revenue topped $1 billion this year, and it has more than $500 million in cash reserves, not including crypto assets. Telegram is under growing criticism from governments over the spread of illegal content and misinformation. Nippon Life Insurance says it's not done with its spending spree, even after making more than $12 billion in deals this month alone. President Hiroshi Shimizu tells Bloomberg that the company wants to buy a majority stake in the LA-based firm TCW Group as part of its global asset management expansion. Nippon Life and other Japanese financial firms are ramping up overseas to overcome Japan's aging and shrinking population.
日本だけではなくって When we look outside of Japan, there is a market with a higher growth rate, which is the U.S. life insurance market. The U.S. has the world's largest life insurance market. Its population is growing, including immigration, and this is where innovation is happening. It is the best place for us. We only had a small business base in the U.S., so we have been looking for opportunities to build a core business base in the U.S. life insurance market for a long time.
Toyota reportedly plans to build a factory in Shanghai, mainly to produce luxury Lexus EVs for the Chinese market. Now, according to Nikkei Asia, Toyota will build its first independently operated plant in China in a move to get more control of its business in the world's biggest auto market. Toyota is planning to open the factory in about 2027. The Taiwanese industry giant Hon Hai, best known for assembling Apple iPhones, has ambitious growth plans in the growing EV and AI spaces. Our tech reporter Annabelle Drewlers looks at the challenges ahead.
iPhones, the Kindle, Nintendo Switch, even Ring doorbells. Foxconn is making these and more. Assembling the devices mostly in China has allowed the company to build an enormous business, generating nearly $200 billion in revenue last year. But the market for many types of electronics, and particularly smartphones, is maturing. Foxconn wants to move up the value chain to products that generate better profits. AI servers is one area where it's making progress. Sales have risen as Foxconn works with the likes of Nvidia, Microsoft, and Amazon on artificial intelligence infrastructure. Semiconductors is another field with a focus right now mostly on older, less sophisticated chips. At present, these mostly go toward in-house needs, including EVs. This is an additional space where the Taiwanese company wants to compete. With a value proposition similar to what it once told Apple, Foxconn can build part or all of your car in less time and at lower cost.
We believe this contracted and design manufacturing service goes same way as smartphones and laptops. So we will have 40 to 45% market share in the future.
Goldman Sachs says EV outsourcing could be worth more than $140 billion by the end of the decade.
But with Foxconn still to sign on a major customer, its grandest auto ambitions are yet to be realized.
Okay, it's going to be a shortened trading day in a number of markets today, as we've been discussing. Japan's not one of them. We'll have a full day's trade there. The Nikkei futures currently pointing higher by about 0.25%. We're going to be closely watching Honda at the open as well, because of course we've had a few more details about that Honda-Nissan tie-up. They have agreed to start merger talks, and form a holding company. That holding company will include Honda's motorcycle unit as well. Now, the plan is to get a listing for that merged vehicle in August of 2026. In the meantime, Honda will be buying back $7 billion of its own shares, so keep an eye on that stock at the open. Could see a little bit of movement there. Mitsubishi is also going to make a decision on joining that tie-up by the end of January. There was some talk of Hon Hai joining that as well, but Honda and Nissan say, well, they hadn't heard of any interest, so that looks like it's not going to happen. Here in Australia, meanwhile, well, the only thing notable about the movement here is how little movement there is. It's going to be a shortened trading day. It's Christmas Eve here at the moment. We've got the ASX just higher by about 1 point, so very, very quiet indeed. We are holding on at the moment for minutes of the Bank of Japan meeting as well. That's for the October meeting, however, so we'll be taking a look back at those when we get them. All right, we have more ahead on the Age of Trade. This is Bloomberg. All right, let's get to our Japan stock reporter, Alice French, as we look ahead to the opening in Japan in just over 7 minutes' time. Alice joins us from Tokyo. Alice, we had some expectations we might finally see some appreciation for the yen in 2025, both the Fed and the BOJ looking to normalize monetary policies. But how's that view changed since last week?
Morning, Paul. Yeah, absolutely. I mean, there were some high expectations that 2025 would be the year that we'd actually see the yen strengthen as the BOJ continues to hike rates and the Fed starts to cut them. But obviously last week we heard the BOJ would not be hiking rates this month, and expectations now lower that they might even do it in January, with Ueda saying that, you know, he's still looking for that one extra notch of economic data to make that jump. And so now, you know, the currency is a lot more unpredictable. We're still seeing a pretty weak yen. That's obviously having sort of mixed impacts on the market. Obviously, a weak yen is good for exporters. It's good for those globally exposed stocks. But at the same time, the sort of uncertainty around the currency, you know, there's even some talk of potential government intervention. We know that some ministers have already vocalized concerns about the currency. And so that uncertainty around the yen is definitely a source of concern for investors going into next year, I think.
Yeah, and if the yen stays weak or gets even weaker, as some hedge funds seem to be betting, how's that going to impact the BOJ's future decisions? And when are we going to get that market? When are we going to get the rate hike?
Well, exactly. I mean, we've definitely seen the level of expectation for a January rate hike fall since last week's meeting. And there are concerns that the BOJ may be kind of forced to actually hike rates if the yen does keep weakening like this for currency reasons, as opposed to because of those sort of economic fundamentals. And there are worries that that might kind of almost undermine the BOJ's policy. You know, the fact that currency would be pushing them to make these decisions, as opposed to sort of, you know, the wage appreciation and the inflation and those sorts of factors that they usually like to look to. So, you know, the majority of market participants are still expecting at least one hike next year, but we're looking at potentially a slightly later one than was originally expected.
And how about intervention as the yen continues to soften? Are you hearing anything about that on the ground in Tokyo?
Yeah, well, we know that late last week, two government ministers did voice these concerns about the currency, and so obviously intervention, you know, could be potentially on the cards. There's always speculation going around. I know that some strategists and traders are expecting that if it does get to that 160 level, that intervention might be the only option. Like I say, this sort of uncertainty and volatility around the currency still going to be a big concern moving into next year, and obviously if intervention does come on the cards, that's going to only sort of heighten those worries. At the same time, on the flip side, there are investors that see it as a great opportunity to invest in Japan from outside. You know, stocks are pretty cheap, so it'll be interesting to see how that relationship between the market and currency continues next year.
Mm-hmm. All right, Bloomberg's Alice French there as we count down to the open in Korea and Japan, and we will be watching those Japan automakers at the open. This is Bloomberg. This is the Asia Trade. We are counting down to Asia's major market opens, and the open in Japan and South Korea now just under 40 seconds away. We are still waiting on Bank of Japan minutes for the October meeting, where of course nothing happened, but we are going to be closely watching those two big automakers in Japan today, both Honda and Nissan. We did have confirmation that merger talks are going to begin. A holding company is going to be formed. The plan is to get that merged entity listed by August 2026. We'll keep an eye on Mitsubishi as well, because they have until January to decide if they want to play some part in this as well. Just a note on Korea, we had December consumer confidence numbers out earlier, 88.4, big drop. Of course, December was the month where we had that brief declaration of martial law. Okay, here we go. We are up and running in Japan and already better to the upside by about 1.2%. So no, it's switched a little bit there. We're better by 1/10 of 1%. 1%, however. Let's take a look at the yen. Little change there as we await those October minutes. But we'll check in on Honda and Nissan. Now, Honda shares not trading just yet. Part of that merger talks was that Honda was going to be buying back $7 billion of its own shares. So those shares are not trading at the moment. Nissan, for its part, though, slipping off about 1.7% at the moment. Not a lot of change there on the 10-year. I mentioned the yen, 157.18. We've got hedge funds piling into the US yen currency pair, betting on a 5% rise in the coming months. That would put the yen even weaker in the 160 to 165 range. So, yeah, naturally, we are on intervention watch from the Ministry of Finance. Well, let's get over to South Korea, see how assets are tracking there. We have got the Kospi also better by 0.4%. The tech-heavy Kosdaq also in positive territory. It was, of course, a very good day for tech stocks in the US, leading the way. Nvidia, Meta and Tesla doing very well there. We've got the won, however, continuing to be somewhat weak, near record lows as we await that political situation to play out. Here in Australia, well, not a lot to say, really. It's going to be a shortened trading day here. It is Christmas Eve. There'll be market holidays on Christmas Day and the day after, Boxing Day, and I wouldn't expect too many people will be showing up on Friday either. So low volumes, tracking sideways, very quiet. We've got a Aussie dollar currently at about 62.5 US cents. We've got an oil price, meanwhile, that's a little bit stronger, better by 1/3%. And that is one area that is moving high on the ASX. Energy stocks performing pretty well on, well, better crude prices at least. Well, let's get back to that top story. Honda and Nissan announcing a tentative agreement to set up a joint holding company. Honda will be taking the leads and nominating a majority of the directors.
Once the definitive agreement is concluded, the holding company will be incorporated and be listed on the prime market of the Tokyo Stock Exchange, subject to obtaining necessary approvals from relevant authorities in resolution at each company's general meeting of the shareholders. The visibility of the timing is August 2026.
We need to benefit from the huge synergies. Otherwise, it wouldn't be meaningful in the eyes of the stakeholders. So that is why we agreed to start the discussion. That is why we are making this announcement today.
But the former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, Carlos Ghosn, told Bloomberg that the two firms don't complement each other and that the deal does not make sense.
There is no complementarity. The two companies are two Japanese companies. They are strong in the same fields. They are weak in the same fields. Both of them have very developed technologies. That means from an industrial point of view, there is duplication everywhere. So industrially, for me, it doesn't make sense.
All right, for more, let's bring in Asia transport reporter Nicholas Takahashi in Tokyo. Nicholas, Carlos Ghosn obviously having a very firm view there of this deal. He doesn't think there's any synergies there, but look, they are both car makers, but there is a lot of duplication as well. So how's this going to work out? Where are the synergies? Could we expect to see plant closures, job losses? What's the talk around this?
Yeah, well, obviously, Ghosn has a lot, sort of an axe to grind with Nissan. But if anybody were to know the synergies that do or don't exist between Honda and Nissan, perhaps it's him. The big question leading up to the announcement yesterday and even afterwards is, what does Honda have to gain from this partnership or alliance or merger? And semantics aside, as you explained just now, Honda is taking the lead. Honda is going to have sort of the pick of the litter when it comes to choosing the board of directors for this new holding company. And so it's Honda's game plan now, and what it gains from the partnership really comes down to what it can squeeze out of Nissan, whether that is production capacity in North America or China, where we're going to see staff reductions. That'll all hopefully start to materialize over the next half year.
Well, we could see another player involved in this as well. Mitsubishi has until January to decide if it wants to play a part in this tie-up. What are the synergies for Mitsubishi? What are we hearing on that front?
Nissan and Mitsubishi have been in a partnership for some years now, dating back to the Renault, Nissan, Mitsubishi alliance. And it was always the junior partner then, and it will be if it agrees to be part of this partnership now. But in a sense, the alliance does sort of round itself out with the presence of Mitsubishi. Honda's got a strong lineup of hybrids in North America, whereas Nissan is sort of lacking in that field, and both companies are struggling with EVs in China. At the same time, Mitsubishi's got a strong lineup of hybrids, and they've got a big foothold in places like Latin America and Africa as well. So where Honda and Nissan might be lacking in hybrids and maybe some of the bigger SUVs, Mitsubishi, for all the rumors, still has a lot to offer, I think.
Yeah, well, just as you're speaking there, we're seeing Nissan shares sinking pretty heavily, off by more than 5% now. Honda shares are still untraded, and Honda saying as part of this deal it's going to be buying back about $7 billion worth of stock as well. But if we talk about this tie-up, we are expected to see a merged entity listing by August 2026, at least that's the plan. And once that happens, how competitive is this merged entity likely to be with Chinese automakers?
Well, I guess as much as this is a non-answer, only time will tell. What we're talking about, if Honda and Nissan and Mitsubishi do pull off this tie-up, is a clean split of the Japanese automobile industry. The trio would pit itself against Toyota and its partnerships with Subaru, Suzuki, and Mazda. Not only would that have a big impact and ripple throughout the Japanese domestic market, this would have strong effects in North America and possibly even China, where local brands like BYD, NIO, and Geely are rolling out wave after wave of these sophisticated EVs that legacy brands can't seem to keep up with. And the whole thrust of this partnership is to catch up with those new consolidated, big and disruptive players.
All right, Asia transport reporter Nicholas Takahashi there. We've got Nissan shares declining quite sharply. Honda still untraded at the moment. Let's get to our next guest now. Qiao is a financial advisor and managing director at UBS. You've got a preference for US and Asia stocks, ex-Japan. Why are you cool on Japan at the moment?
Well, we're currently still mostly focusing on U.S. The U.S. has done extremely well this year, and going to 2025, especially with the backdrop of U.S. equity markets remaining very supportive, mainly driven by durable growth, Fed rate cuts, the new incoming Trump administration. We are expecting that they will likely pursue pro-growth policies. So our focus still now in terms of the equity markets is still U.S. And Asia, there's also opportunities, but we are just not looking at Japan at this point.
Well, some of the best returns we've seen in 2024 have actually come from Chinese banks. What's your outlook for China? Is that a market that you would be allocating more to, considering we're likely to see some more support from the government, but then on the other hand, there's the risk of tariff and trade war from the incoming Trump administration?
Absolutely. I mean, China is always remains as a huge market and has huge potential. We are just still, with the uncertainty with the tariffs and also the property market crisis that still needs to stabilize. Also, the government stimulus, there needs to be more support from the Chinese government. We kind of just are remaining on the sidelines with China in general, but there's a lot of other opportunities in Asia, like Hong Kong, Singapore, Malaysia, surrounding countries in China are good markets, but I think we rather hold on the sidelines for China at this moment, but there's definitely a lot of potential there once there's a little bit more certainty with the tariff situation.
And in terms of US market, it's been another stellar year for the S&P, but some of those names, particularly on the tech side, are looking pretty expensive. Is it still a buy? How much upside do you see for the S&P in 2025?
I mean, that's a great question. This is what everyone's, thinking about, right? It is very expensive. Some of the stocks are all-time highs, but it may not be as expensive as it appears. We are certainly expecting further upside in equity, particular in technology, because of all the AI growth, all the AI investment spending, and that's going to continue to accelerate and lead the growth in 2025. That's what we're expecting at this point. So we hope that next year, I mean, it will be modest, in general, modest growth. S&P could reach to 6,600 by the end of next year.
And do you look at other ways to play this AI trade? Because it's a very energy hungry, particularly in terms of electricity. Do you look at energy generators as a potential target for investment?
Absolutely, and that's a great point. I mean, a lot of investors who are afraid because some of the tech names may be too expensive. Utilities is also a good place to look at. With all the investing in power and resources, the rising electricity demand, that's certainly going to push earnings higher in that area, especially with all the industrial electricity that's going to be used for all the AI and for AI power usage. So utilities has been, just hasn't been as expensive as technology, and that's a great area to look into.
I want to turn to your expectations around Fed policy as well, because some of the discussion around last week's rate cut is that it might not have happened if the markets hadn't priced it in so aggressively. But do markets even need support at the moment from the Fed, particularly when you consider the strong growth that we're seeing, the consumer, notwithstanding today's drop in consumer confidence in the US, still looking pretty good, and jobs market still strong as well?
Yeah, absolutely. I mean, we feel like the Fed is doing what it's supposed to be doing, and we feel pretty good about the rate cuts next year. Whether it's going to be 4 cuts or 3 cuts, the Fed is likely going to want to see lower core inflation before it cuts interest rates further. So core inflation came in at about 2.8. So we are expecting probably in June next year, that's when it might get down to 2.5. So if inflation numbers are still hot in March, Fed could skip that rate cut and just, we're probably going to see another 25 bips coming down in June or in September. So it will be slower rate cuts, but it's still going to happen. And it's just, it's kind of a way that our economy is going to continue, or the rates are going to continue to normalize. And eventually the equity markets are not going to be, I mean, we feel like if it's on this trend of rate cuts, it's not going to be as affected.
Now, look, I know you like gold as well, but that's traditionally where you might run for cover. Is there something you're worried about here, and do you have a price target for gold?
Yeah, gold actually has sold off recently, and I'm glad you brought this up, because we believe gold will remain an effective hedge against key political concerns, right? With all the geopolitical concerns right now, including some of the government debt levels, inflation, and just some of the tensions there is geopolitically. Gold is a great hedge, against some of these concerns. So in terms of, not just gold, but oil market is also, consensus has been saying is oversupplied, right? And then we also think that with the current low prices, which could lead to lower supply growth, causing higher prices on supply disappointment. So both of these areas, gold, oil, are some markets that investors can look into as well.
All right, Qiao, financial advisor and managing director at UBS. Thanks so much for joining us. I want to check in again on Nissan. It is extending its declines. Well, it's off 5.5% now. It was off getting close to 7% a moment ago. Now, this is, of course, on the news that we received that Honda and Nissan have agreed to start merger talks. They'll form a holding company. The plan is to list that merged entity in August 2026. But it's pretty clear that Honda's going to be taking the lead in this deal, and it's going to be buying back $7 billion of its own shares. Honda untraded at the moment. We have more ahead on the Asia trades. This is Bloomberg. Well, we've got Honda shares trading now, started just moments ago, and look at that, better by more than 12%, perhaps unsurprising because part of the plan with the merger talks between Honda and Nissan includes Honda buying back $7 billion of its own shares. So that has propelled Honda shares dramatically higher this morning, better by 12.3%. Nissan shares, meanwhile, going in the other direction. They're paring their losses, though. They were off by about 6.7% at one point, now softer by about 4.5%. Well, Elon Musk, who has been appointed by US President-elect Donald Trump to make the government more efficient, is called the Federal Reserve overstaffed. Our news desk editor Jill Desis joins us now. Jill, what's Elon Musk's definition of overstaffed? What's he saying, and has the Fed responded?
Well, we didn't really get that much more of him outside of that tweet, Paul. So I think all you can really derive from here is a lot of context about what's happening. Obviously, as you mentioned, Elon Musk has been really heavily involved, not only as an advisor within the Trump administration, sort of informally, but also kind of taking on this role in this government efficiency department, saying, you know, he wants to capture some $2 trillion in savings somehow. He also, of course, was a pretty key figure in the budget process that unfolded last week, trying to slim down that spending bill that's keeping the government funded through March. All that being said, though, Paul, I think there's a couple of key pieces of context here that we really have to keep in, just sort of keep in mind. First of all, the Federal Reserve is not funded through the regular congressional budgetary process. So not really clear from, I guess, an Elon Musk perspective, where he wants to find efficiencies within the Federal Reserve, how it would do that. The Federal Reserve kind of, it makes its own income, so sort of like it takes care of itself there. I think the other key part of this, too, is that when you look at the totality of the Fed's staff, it's somewhere in the neighborhood of 24,000 employees. It's actually smaller than, sort of equivalent systems like the Euro system and such. And so it's not quite clear where, either Elon Musk or Donald Trump, where he wants to get involved, where they would look to try to make those trims and how exactly those would happen. All that being said, Paul, I do think that it's worth mentioning that obviously Donald Trump himself has gotten quite involved in sort of pushing back against the Fed. Of course, he's the one that appointed Chair Jay Powell, but he said that he wants a bit more influence over how the Fed actually acts, or has suggested that at least. So I think that, again, not really clear where we kind of go from here, but kind of important, I think, to keep some of that context in mind.
Ordinarily, that'd kind of be enough to try and digest, but it's barely 24 hours since President-elect Trump suggested the idea of renationalizing the Panama Canal. Now he wants Greenland. What's this about?
Yeah. Well, look, I think, the Greenland debate here kind of opens up, a whole little, history, geography lesson here and how some of this happens. I remember back in 2019 when Trump first raised the idea during his first term that he wanted to buy Greenland. There was a lot of questions there. So what Trump is ultimately saying here is, he obviously recognizes the strategic importance of Greenland. Of course, think, when you take into account, Russia's war in Ukraine in particular, having that giant landmass, that's sort of positioned between America and the Arctic, certainly is very attractive. The U.S. actually does have some, strategic, bases that are based in Greenland. But of course, we've heard from, Denmark, Greenland's not for sale, will never be for sale. Whether this is just kind of an effort by Trump, to kind of get some kind of a cooperation moving or some kind of a negotiating tactic there, I think that's kind of the open question here. All things that maybe we'll get a little bit more clarity on once Trump actually takes office on January 20th. Of course, he keeps saying all these statements, but he's not yet in office. So we'll have to see what actually happens once his, second term officially begins.
So many questions. All right, news desk editor Jill Desis there. President Biden's administration, meanwhile, is launching an investigation into Chinese-made semiconductor chips, and this is a move that could lead to new tariffs. China correspondent Min Min Lo joins us from Hong Kong. So Min Min, what's new about this investigation?
Well, President Biden's administration has already been pushing out a series of measures to really tighten the noose on China's access to advanced semiconductors and equipment. But this investigation is going the opposite way. It looks into the export of Chinese legacy chips into the U.S. These are older generation technology chips that are used in everything from cars to medical devices to mobile phones, for example. And these investigations, they typically take 6 to 12 months, by which time President Biden will no longer be in office. So that leaves the decision of what to do with the outcome of this investigation with President-elect Trump and his incoming administration. What Trump could do is potentially to raise tariffs or to impose more import restrictions. U.S. officials like Gina Raimondo and Catherine Tai, for example, they are saying that these Chinese chips could potentially threaten U.S. national security, and that the existing measures are not enough to stem the flow of potentially artificially cheap chips from China into the U.S. Earlier this year, Washington has already increased the level of tariffs on these Chinese legacy chips from 25% to 50% by 2025.
So has China responded to this yet?
Yes, the Chinese Commerce Ministry has responded. Obviously, they are not happy and they are strongly opposed to this investigation, and they're pointing out the double standards that the U.S. is applying here. The Chinese statement says that U.S. is pouring in huge sums of subsidies to support U.S. chip companies through the Chip and Science Act, and that U.S. companies now make up about half of global market share, while Chinese chips make up only just 1.3% of U.S. market share. So the statement said that this is obviously self-contradictory, that the U.S. is exaggerating the Chinese threat, and China is vowing to take all necessary measures to protect their rights and interests.
All right, Bloomberg's China correspondent Min Min Lo. We have more ahead on the Asia trade. This is Bloomberg. Let's get the latest now from the corporate front. Nippon Life Insurance says it's not done with its spending spree, even after making more than $12 billion in deals this month alone. President Hiroshi Shimizu tells Bloomberg that the company wants to buy a majority stake in LA-based firm TCW Group as part of its global asset management expansion. Nippon Life and other Japanese financial firms are ramping up overseas to overcome Japan's aging and shrinking population.
When we look outside of Japan, there is a market with a higher growth rate, which is the U.S. life insurance market. The U.S. has the world's largest life insurance market. Its population is growing, including immigration, and this is where innovation is happening. It is the best place for us. We only had a small business base in the U.S., so we have been looking for opportunities to build a core business base in the U.S. life insurance market for a long time.
Toyota reportedly plans to build a factory in Shanghai, mainly to produce luxury Lexus EVs for the Chinese market. According to Nikkei Asia, Toyota will build its first independently operated plant in China in a move to get more control of its business in the world's biggest auto market. Toyota planning to open that factory around about 2027. All right, let's take a look at the diverging fortunes of Honda and Nissan shares today. Nissan weaker by 5%, although it was much lower than that at one point. Honda surging 13.33% at the moment. Honda announcing it'll sell buy back $7 billion in stock as part of that tie-up. This is Bloomberg. Got some breaking news out of Australia now. It is minutes from the Reserve Bank of Australia's last meeting. RBA saying it's gained confidence on CPI since the prior meeting, but there are still risks. Of course, the RBA has been sitting on its hands for more than a year now. No rate cut relief for homeowners here in Australia. The RBA also noting uncertainties over the level of policy restrictiveness. but the board judging that the upside risks, at least to inflation, have diminished, and a number of measures of financial conditions have loosened somewhat. Not clear if recent consumer spending strength is going to persist, though, and it's too soon to conclude if CPI is moving sustainably towards target. So nothing here to suggest that the RBA is in a hurry to ease any time soon. The cash rate has been parked at 4.35% for more than a year now. No movement from the Aussie dollar on that news either, as you might expect, and barely any movement on the ASX either. We're really going sideways today. Very low volume. It's going to be a shortened trading session. It is, of course, Christmas Eve, so it's a public holiday tomorrow. It's a public holiday on Thursday, and I'd be willing to bet that not too many people are going to be wanting to show up to work on Friday either. So the ASX trading firmly in holiday mode at the moment. Let's take a look at markets elsewhere. The Nikkei looking pretty flat right now. The Kospi better by just a few points as well. The big story of the day in Japan, though, is of course the Honda-Nissan tie-up. Nissan shares are sinking quite dramatically. Honda shares appreciating even more dramatically, better by more than 13%. Honda announcing that it'll be buying back $7 billion worth of shares as part of that tie-up, the joint entity hoping to list in August of 2026. Well, a recent bounce in Chinese developers' stocks might be short-lived, with the country's real estate woes set to worsen before they get better. Equities senior reporter Abhishek Vishnoi joins us now. So, Abhishek, why is the outlook for China's property sector still so bearish? Have we got some new signs of distress emerging?
That's right. There are fresh signs that the liquidity crisis continues and it will expand itself in the fifth year. And it shows that, worst is far from over for China's property sector. And similarly for China's property sector bonds and stocks. There are fresh signs that have emerged, and which has led to analysts and investors expecting further decline in home prices and sales in the sector. And that's why the outlook is not too bright for the sector as New Year begins. Now, in terms of fresh signs, banking regulator has asked insurers to check what kind of exposure they have to China Vanke. That's one of the developer which has not declared default so far. So that is very worrying. That shows that liquidity crisis is engulfing those developers which have so far remained aloof from this property crisis, which have so far managed to navigate themselves. And among other signs, there are also signals emerging that this crisis is still having impact on offshore names like New World Development Co. in Hong Kong. That has asked lenders to delay some of its debt maturities. There is another lender which is looking to exit one of the prime properties, commercial properties. So, overall, the outlook is not too bright, and that's what is going into expectations of possibly decline of about 5 to 10% on home prices and almost similar kind of decline in home sales.
This crisis has been dragging on for a while now. I think we're in the fifth year. What's it mean for stocks and China's market overall?
For the stocks, there are two things which are very clear. This is a liquidity crisis. So, stocks are going to take lead from bonds, and property sector bonds are still trading at distressed levels. So, there's not, really much, bullish to talk about. Second thing is that developers which are linked to government might be better off in terms of navigating the landscape. So our reporting shows that China Overseas Land, China Resources Land are among the top few picks that analysts are looking at in terms of navigating this crisis in the fifth year. And for China markets overall, property obviously contributed one of the biggest portion in GDP all these years, and it's entering into its fifth year of slowdown. And that doesn't really bode well for the economy overall. It has a sort of a trickle-down effect on the consumption, on all things related to property, furniture and things like that. Therefore, it may add to the deflationary forces, and thereby the valuations for Chinese market overall would remain in check. So currently, MSCI China is trading at closer to about 10 times of its one-year forward earnings. Unless outlook improves for consumption, which is again tied to property sector, wealth effect, valuations would remain at around these levels. That's what investors and analysts are telling us.
All right, Equity senior reporter Abhishek Vishnoi there. Some of the other stories we're following from around the world. French President Emmanuel Macron has picked Eric Lombard to be the country's finance minister. Lombard, an experienced finance professional, faces the task of repairing France's finance after the collapse of the previous administration over next year's budget. Now, the country's been in political turmoil since June, when Macron dissolved parliament and called for elections. Malaysia's state-owned investment fund, 1MDB, has filed a $1 billion claim against a Hong Kong-based corporate services provider to recover its stolen assets. 1MDB said that Amicorp facilitated fraudulent transactions worth more than $7 billion and played a vital role in enabling the government investment company to be defrauded. Former US President Bill Clinton has been hospitalized for observations after developing a fever. The spokesman says the 78-year-old remains in good spirits. The former president was active on this year's presidential campaign trail. Clinton underwent a quadruple bypass back in 2004. Fire restrictions are in place across the state of Victoria in Australia due to a large bushfire in one of its most popular national parks. Authorities warn of catastrophic conditions in some areas over Christmas, with temperatures expected to rise and strong winds forecast. Residents who evacuated from nearby towns have been told it's not safe to return. More ahead on the Asia trade. This is Bloomberg. Let's just take a quick recap of the RBA minutes that we received a short time ago from the last meeting, where, of course, the bank stayed on hold again. We've been at 4.35% for more than a year now, but the RBA saying it has gained confidence on CPI since the prior meeting, but there are still risks. It is, of course, sticky inflation, one of the key reasons that the RBA has remained on hold. It says it will continue to be guided by how data shapes the economic outlook, but it is too soon to conclude that CPI is moving sustainably towards target. Not a lot of movement in any of the Aussie assets that we track, but of course it's a shortened trading day and we are on the cusp of a very long summer holiday here. Well, Bloomberg Economics sees a brighter year ahead for the Australian economy, but growth will still be dependent on policy. Australia and New Zealand economist James McIntyre joins us now. And James, we did hear from the RBA a moment ago. Still not a lot of confidence there on CPI. How's the inflation and growth outlook looking? Are we going to get cuts in 2025?
Well, they're still reticent, Paul. Thanks for having me, by the way. The RBA is still reticent. They want to, see that inflation is coming down and it's coming down sustainably. On the growth front, though, things are starting to look better. But how good things look is really going to determine the pace of policy easing. So when we're looking at 2025, we see not just the RBA policy easing, but a whole range of other policy measures as really being the linchpin for growth. Not so much the US administration, but a lot of domestic policies. We've got a federal election coming in the first half of the year. Migration has been a very big touch point for the economy. It's also been something that's been giving a surprisingly strong and resilient demand boost, something that's kept the RBA sidelined for so long. We've got one of the longer periods on hold from the RBA. But we see that migration story easing back, taking some of the wind out of demand. And on the other side, that should allow that inflation to continue to ease forward in the RBA to gain that confidence to cut. We think February's live, and there's a possibility of up to 100 basis points of rate cuts in the year ahead. And that should be enough to get growth going up, lifting up from about 1% in 2024 to almost 2%, just shy at 1.9 in 2025. That's our overall big picture view for Australia next year.
Is that going to perhaps reanimate the consumer who's in a pretty dark spot right at the moment in Australia?
Yeah, they are. They are. Look, it's not only in terms of the bright spot in sentiment, but when we look at the numbers, that migration's been a key, as I said, support or prop for demand. But per capita spending has been in recession, and it's been in recession for a long time. And it's the worst we've seen since that 1990s recession, early 1990s recession in Australia. So very, very weak consumer. You haven't noticed it because of migration, but as that pulls away, we're going to need to see consumers open up their wallets. And when we're talking about the growth outlook being policy dependent, and the RBA is one of those pieces of the policy puzzle. Without, you're not going to get the rate cuts without a little bit of softening in consumer spending, but you're also not going to get that strengthening in consumer spending into the second half of the year, really driving that growth impulse towards the back end of 2025 without the RBA coming through.
All right, Australia and New Zealand economist James McIntyre there. Well, let's get more perspective about how consumers in Australia are spending this holiday season. Joining us now, Sarah Megginson, head of editorial at Finder.com. Sarah, give us a sense of where the Australian consumer is at the moment in terms of what your data is telling you.
Yeah, well, probably not surprising, similar to what James was saying. We are seeing spending trend down, and after 3 years of a cost of living crisis, it's not surprising to see people are spending less over the Christmas season, but they're still spending a phenomenal amount. So our research shows that this year, Australians are spending around $28 billion over the silly season. So there's still plenty of money flowing through the economy. It's just down about 8% on where we were this time last year.
And how's Christmas spending looking this year compared to previous years?
Well, as I said, it's 8% down on last year, but it's still reasonably strong. It's around $1,350 per person on average, and a huge chunk of that is still going towards gifts. Around $400 of that is going towards gifts, and a huge amount is still being spent on travel. So I think at Christmas time, particularly after a tough year, we all want to be close to family. So prioritising spending time together and having that travel spending is still a really high priority for a number of Australians. It's just a little bit less than it was in previous years.
Well, we've got persistent inflation, of course, and this is something I was discussing with James a moment ago, and the Reserve Bank, because of that, hasn't eased for more than a year and is showing no signs of doing so. Is this the whole story in terms of weak consumption, or is this only part of the story?
I mean, it's so fascinating because we've been following this data for a number of years, and every year we expect around Christmas time for that spending to slow down and for the bite of these really high interest rates to be showing in consumer spending. This is the first year actually in 3 years of us tracking this data that we've seen Christmas time spending trend downwards. And as James was saying, it's going to be really fascinating to see what happens next year. We were expecting at some point in 2024 to get an interest rate cut, and it never quite came through. So we're all kind of pinning our hopes on February as being the time that we see that cut. And that's really important too, because we will see a Christmas spending hangover in January. We know that every year credit card spending skyrockets over Christmas. January, a lot of people start the new year with a debt to kick off January. And we're also seeing an increase in buy now, pay later debts every new year as well. So it's a really not the ideal way to start the new year. And if we could get to February and see an interest rate cut from the RBA, that would certainly alleviate some pressure for Australian consumers.
What are some of the other things that are impacting consumer habits at the moment? Because I know you've found that there is a role to social media in all of this as well.
Yeah, that's also a really fascinating trend that we're seeing. A lot of the big social media giants are all putting a lot of energy into monetizing more directly through shopping. So for a long time, you've been able to shop through social media, you've been able to click on the links and go straight to different retailers. But now they're all starting to introduce these modalities where you can buy directly while you're in the apps. And interestingly, the number one platform that's driving that is Facebook. And we would have thought that it was perhaps more younger consumers in TikTok and Instagram driving that spending. But Facebook is older consumers, and that is 61% of Australians are using Facebook to drive their spending decisions. But we're going to see that increase. We certainly know that it's so much easier for for people to spend now. Retail hours are not limited. It's not limited to when you can get to the shops. It is literally 24/7. It can be 2 o'clock in the morning on a Tuesday and you can buy practically anything. So those opportunities to spend are really, really prolific these days. And it does make it harder for people. There is that temptation to spend and get those dopamine hits at different times. So it does make people harder to rein in that spending. And over Christmas, of course, we have so much pressure on families who have had a really tough year with all of their bills, with their home loans, with insurance, with energy. You know, every aspect of our bills have been impacted. Then we have Christmas spending, and coming straight off the back of that in January for a lot of families, there's back to school costs as well. So this is a really tough time for families. Hopefully we'll see in February, or at least, you know, early in the new year, we'll see some of those interest rate cuts start to come through and take a bit of that pressure off for Australian consumers.
Well, also in the first half of next year, we are going to have an election, and immigration is shaping up as a potential issue here. We've already seen some tightening of policy on this from the government, but it's been responsible for a lot of economic growth in Australia. Is there a risk that this has an impact on consumption as well?
Absolutely. And I think it's been a really interesting few years. Where we are right now is not quite where we expected to be when the RBA first did modelling, when interest rates were very low, under 2%, and they were modelling what it would be if we added 3% to interest rates. We thought that the economy would be in much worse shape. They were predicting mass bankruptcies and, you know, a huge amount of pain for Australian consumers. And we haven't had that eventuate, certainly not anywhere near the level that we were expecting. As James, your previous guest, was sharing, a lot of that has been absorbed by immigration. So, you know, we're not exactly where we expected we were going to be. And every year, I would say for the last 3 years, we've ended the year saying, hopefully the tide is going to turn in January. I think this year is the first year we actually have that optimism of properly expecting that we're going to see interest rates start to come down and take that pressure off mortgage holders, but we know that it's not just mortgage holders. The rental market has put so much pressure on Australian consumers as well. So no matter where you stand, you have had a difficult 2024 and the years before it. So hopefully 2025 is that year where we start to see some of that pressure lifted.
All right, Sarah Megginson, head of editorial at finder.com. Thanks so much for joining us. Now, we've got more on Australia ahead every Tuesday, 11:40 a.m. if you're watching in Sydney, 8:40 a.m. Hong Kong time. Plus, you can tune into the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify, or Bloomberg.com. Right, let's check in on New Zealand assets because they're done for the day. They're taking an early market as Christmas Eve, and they'll be off for the next 2 days, back on Friday. But yeah, let's see if they're back with any enthusiasm. Closing higher by 2/3%. Kiwi dollar looking very soft against the greenback at 56 cents, although pretty much everything's looking soft against the greenback these days. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at some key crypto assets that we're tracking. Bitcoin staging a modest recovery at the moment, but we're well below those highs we saw after the US election. Still pretty strong though, 94,200. In crypto-related news, Hyperliquid, a crypto derivatives platform, suffered its biggest daily outflow on concerns that North Korean hackers are trading on the exchange. But most of those key tokens are fairly stable at the moment. Well, Singapore's forging ahead with efforts to formulate a digital assets hub, while rival financial centre Hong Kong struggles to gain traction. Bloomberg cryptocurrency reporter Sivashri Ghosh has the details. So Sivashri, what's Singapore's approach to developing as a digital assets hub?
Hi, Paul. Thanks for having me over here in the studio. So basically, Singapore has turned into a little more cautious stance after the blow-ups we saw globally in 2022. Some of them were also based out of Singapore. So after that, Singapore has been tightening its crypto regulations. It has already, banned public advertisements by crypto companies. It discourages retail investors in in Singapore in trading in cryptocurrencies. However, we have seen that the Monetary Authority of Singapore, which is a central bank of the country, has been keen to develop the city-state as a blockchain hub, So it has been trying to develop the infrastructure that helps in easing cross-currency payments, reducing the cost of such payments, making it a little more easy for infrastructure for blockchain using it between institutions like banks for settlement of cross-currency assets. So it's been more of a blockchain and infrastructure-led push by the Monetary Authority of Singapore over here, rather than focusing on just cryptocurrency trading. So that has been the overall approach for Singapore as it aims to develop into a blockchain hub in the region at least.
Well, how do we compare that with the experience of Hong Kong then? And is there an influence of China here when it comes to any ambitions to become a global crypto hub?
Indeed, that's a very interesting question, Paul. We know historically Singapore and Hong Kong are the biggest financial centers in this region, and they are there is a healthy competition between them. Hong Kong had allowed retail crypto trading, in fact, opened the borders for crypto trading in June last year, 2023. Since then, it has taken quite a few initiatives, like, it has allowed exchange-traded funds in Bitcoin and Ethereum over there. It has also come out with a sandbox for stablecoin platforms, and also come out with rules for custodians in crypto. So Hong Kong has been taking small baby steps to progress and become another hub in the region for crypto. However, as you rightly said, there is a little bit of shadow of China over Hong Kong, in the sense that we know that China has banned crypto trading in the mainland, and therefore concerns that overall Hong Kong's regulator is pretty concerned that there should not be any spillover between China and Hong Kong when it comes to the money coming out from the Chinese borders into Hong Kong. So that's been a little bit of a dampener for cryptocurrency investors in Hong Kong. And that's been more or less the regulatory comparison between the two countries.
All right, Bloomberg cryptocurrency reporter Sivashri Ghosh there. Before we leave you this hour, let's take a look at how Japan's big automakers are doing. We've seen a big surge in shares in Honda, better by 13.5%. Honda announcing it will buy back $7 billion worth of its own shares as it agrees to merger talks with Nissan. The plan is to form a holding company and ultimately list in August of 2026. Mitsubishi has until January to decide if it will participate. This is Bloomberg.